And we're live, Sandeep. We can begin.
Okay, still saying host as disabled.
Yes. Just give me 1 second. Yeah, Sandeep, you are the host now, and we can begin the session. We are live on YouTube.
Okay, great. Hello, everyone. Welcome to Gulaq's webinar on retirement. Today, we are going to be talking about retirement planning and how to feel safe and secure in your savings plan so that you can continue to enjoy in your golden years. My name is Sandeep Tyagi. I'm the CEO of Estee Advisors, and Gulaq is a registered investment advisor which provides model portfolios for investment purposes. Now, I'm going to be sharing my screen and taking you through some material on retirement planning. Let's get started. The first thing is, why is it that retirement planning is becoming a much more important topic than it has been? I think in India, retirement planning used to be your children. Parents used to invest in your children's education, and the assumption was that the children will support parents in their old age and in their retirement. But with the social changes, nuclear families, things are changing. Everybody wants financial independence now. You may want to plan enough resources so that you can take care of your own needs. The family dynamics are changing for sure. There aren't enough social security systems. There is things like PPF, and we'll talk about NPS, but those savings and are usually not enough to maintain the lifestyle that you may get used to. And private sector for sure does not provide any pensions. So all these reasons make it necessary that we look at retirement planning as one of our main savings goal while we are saving during our working years. So the first question for people who are online right now, what is the age at which you plan to retire? There are some people who want to retire as early as 40 or even earlier. I believe especially the millennials are big on thinking about retiring early, getting their financial independence, and the FIRE movement is focused on getting to a point where you can really be pursuing your passions and hobbies and not have to work for money. 40 to 50, some people would consider that. 50 to 60 is probably most common. 60 to 70, as some people push the boundaries and continue working late into their ages, and even 70 plus. We have people like Charlie Munger and Warren Buffett who are working in their 90s and still very active. So the first question for you to understand is, what is the age at which you plan to retire? Now, the factors to consider in your retirement planning are, what are your annual living expenses? This is not an easy question to answer, especially if you think of in future. People get confused about how would things change, what would inflation do, how much more expensive things will become over a period of time. One easy way to deal with this is to take your current living expenses, obviously make the obvious adjustments, like if you are supporting your children right now and don't expect to be doing that in retirement, then you can reduce that expense. You may be putting away a lot of money for savings or paying down, let's say, a home mortgage or EMIs. And at your retirement age, you won't be doing that. So again, you can reduce that. But get a current estimate of your living expenses. Then you can simply increase it by a fixed amount of inflation. A good estimate for a country like India might be 5%, 6% a year. And if your retirement is 20, 30 years out, you can get an estimate of what your expenses would look like. The same thing is you may have savings and you don't know what would be the investment returns. Again, you can build some assumptions around how much savings you have today, what you would be saving every year. And if you put in some investment growth returns, what would you have as your investments when you retire? Just these two would require some kind of a calculation, maybe an Excel sheet. If you're not comfortable doing that, we have tools available on Gulaq website where you can put in simple numbers and it will give you a table of what your retirement plan would look like. Life expectancy is the next thing. Now, here it is a bit tricky, and I will take you through a little bit more. Average life expectancy is about 71 years. But as we grow older in the age, we are reducing the chance, we have already gotten to a certain age. So for a 50-year-old, the life expectancy would be different than the average. So how many years you are going to have to live in retirement is something that you have to keep updating over the period in which you're saving. Of course, at what age you're saving the plan has an impact, and what kind of an asset allocation will you have, which we have done other webinars on. Putting your money in fixed income will get you one savings plan. Putting your money into equity investments will give you a very different asset plan, and finding the balance between the two is yet another way of going about doing this. Now, as I mentioned, in 2023, India has life expectancy of 70.4 years. But if you're a 50-year-old person, your life expectancy goes to 80 years. Now, people entering the workforce right now will be retiring in 2060s. Now, where the life expectancy may have gone up significantly to 77 years, and if at that time you're a 50, 60-year-old person, maybe your life expectancy is 85 years or 87 years thereabout. So if you plan to retire at the age of 65 and expect to live to 85, 87, you have 20 years in which you have to live using your savings and need to plan accordingly. Now, the next question is about asset allocation. This methodology of gear-based investing is something very specific and proprietary to Gulaq. We have come up with this method using the analogy of gear-based driving to help you understand what does asset allocation do. Just like in a driving situation, depending on weather, depending on the road condition, depending on your own skill set, you choose the gear in which you will drive the car. Similarly, in investments, you choose the gear to appropriately balance your portfolio. When the conditions are good, you feel confident, you have enough savings, then you can take a little bit more risk and go faster, which means you can invest in gear 6. So if you're a young person in your 20s and 30s, you can invest in gear 6 and grow overall portfolio for next 10, 20 years very fast compared to keeping your money in fixed deposit. When you're reaching the time period when you have stopped kind of earning and you are now halfway through your retirement years, you're going to keep bringing your investments down to gear 1, which means you are going to have more of your investment in fixed income, less of investment in equities, so that the market variation does not have a huge impact on your lifestyle and what you can spend. So this asset allocation plan is extremely important for you to understand what stage you are in and how to adjust your allocation to stock market versus fixed income securities over this period of savings. Now, This grid shows you the two main important factors. The first is how close are you to getting to the retirement age? And the second is how much savings do you have? If you have a lot of savings and you are early in your retirement planning, then you can take more risk and you should be investing in gear 6, which means all your money should be invested towards equities, which over long term deliver better returns than fixed income. On the other hand, if you have less savings or you're very close to retirement or both, then you should be in gear 1. And then in between mixtures is like gear 3. There are some people who are in their late 80s or even 90 years old. They have over lifetime saved a lot of money. That money is not going to be used by them during their lifetime. So really, they don't need to be very conservative. They can keep more aggressive portfolio because what they are saving is for their estate, whether to give their children or to give to charity or for whatever other purpose, but their own needs are going to be met in all conditions. So they can be a little bit more aggressive in their planning. Now, here is a case study. Chanchal Kumar, who's 30 years old, lives in Delhi, earning 30 lakh a year. His wife is a homemaker. He wants to be independent along with his wife in retirement. So he wants to retire when he is 55. So he's got 25 years of working. And he is expecting to live till 80 years of age. He thinks he would need 1.5 lakh a month in today's money to sustain his standard of living. Now, he himself thinks he's an aggressive investor. What should be the right plan for this gentleman? Now, as we discussed, because he's a young person, many years to go, and overall, he has got enough of a saving and corpus, he should be 100% in equity. Over historical periods, the return in equity markets has been 11.2%. We can assume inflation to be 6%. So the savings requirement for retirement every year, because he's still earning, so he's going to get promotion and job or otherwise grow, we assume he'll grow at a 12% annual rate. He doesn't have any current saving because he's just starting. And post-retirement, we expect he will reduce his risk to gear 4. Now, in this portfolio, with no other source of post-retirement, he can easily meet all his requirements. And this plan would be appropriate. Again, we have a template online in Gulaq where there is an Excel, and you can put all these assumptions in that template, and it will generate whether you have sufficient savings to meet your needs or not. I guess in the case study, Chanchal would save 3.2 lakhs annually for retirement corpus. His contribution will keep increasing at 12%, as we mentioned. He's investing in gear 6 initially. And in the later phase, he's moving to gear 4, where the return is expected overall to be 10.76%. So the plan is likely to help Chanchal to meet all their needs up to the age of 80. And we'll talk about some of the risks and what can change, because sometimes returns can be higher or lower. You can live longer than what you expected. What would happen in those cases? We'll talk about that a little bit now. So as I mentioned, investment returns are variable, even though we expect them to make 11%. But year to year, they can vary quite a bit. Sometimes they can even be negative. In other times, they can be generating 25, 30%. Inflation can vary. It can go higher or lower. So your plan is a dynamic plan. You can't have a static view of whether your plan is sufficient or not. You may get additional income source. You may grow faster, or vice versa. You may have a problem in a year or two where you're not able to save as much. Again, life expectancy, particular the variability of life expectancy. So on average, a 50-year-old will live to 80 years of age. But of course, that means there are some people who live to 90 or even beyond. So you can't save only for average, because what will you do if you are in the half of the people who are going to be living for more than 80 years? And that's where a product like annuity becomes important, because annuity is a mixture of savings and an insurance plan. It pays a fixed amount as long as you live. So a life annuity helps mitigate this risk of what happens if you live longer. Now, sequence of return is another risk that we can talk about. Let me show you a chart. Here is two scenarios where it is the same total amount of return. So the first year is 25%, 15%, 10%, 5, -5, -10, -15. And in series 2, it's the same returns, but in the reverse order, -15, -10, -5, 5, 10, 15, 25. What do we observe here? Interesting thing that the total money at the end of 7 years at 12,066,321 is exactly the same. So if you have the same returns in 7 years, they can be in any order, you will end up with the same amount of final corpus. But is that really true if you are in your retirement phase and you are using some of that money? So here we have withdrawn 5 lakh a year, and what happens? In series 2, you end up with 9 million, and in series 1, you end up with 9 million, and series 2, you end up with 7 million. Significant difference, more than 20% less if you are withdrawing consistently. Why? Because when you had the negative return early on and you withdrew money, you don't have the time to recoup all the gains. So this sequence of return has an impact on what your final outcome is going to be. So how does one mitigate this risk? The way most retirement planning, I guess, advisors or software think about this is to say, just withdraw 4% a year of whatever your corpus is. And if you do that, then you'll be fine. What our thinking on this matter is that what you want to do is almost adjust your spending in line with your returns. So if the return for the year has been down, spend little less and withdraw little less. Let's say you withdraw only 2.5%, not 4%. And the years where the returns is high, you can spend some more. Take an extra vacation, spend on a fancier car, and that's going to be okay. So if you adjust your spending instead of a constant 4% year on year in good and bad years, you have a risk of ending up with significantly lower money. But if you adjust your savings, your spend pattern in line with your returns, then you have a much better success rate of meeting your retirement goals. Now, let's talk about NPS. NPS is a government scheme in which you can save up to 2 lakhs of money tax-free. Not only do you save money from your pre-tax income because it gets deducted from your taxable income, but withdrawal also is quite tax advantageous. So you can choose a manager. There are several asset management companies who can provide you retirement savings plans with your NPS. And the cost is also fairly mitigated because the government has capped the amount they can charge in an NPS account. Now, the tax benefit I already talked about, the saving is from pre-tax money. 60% of withdrawal at a certain age is tax-free. And with the rest of the money, you can buy an annuity. Now, as I mentioned, you can do 60% of corpus without paying any taxes. So the money you put in was without taxes before taxes, and the money you withdraw is also fairly advantageous because you don't pay taxes. And you can set up a systematic withdrawal plan to get money every year without having to pay any taxes. The 40% that is left, you can buy an annuity plan, and that will allow you to mitigate the risk of the time period in which you are using your retirement savings. So that creates a benefit of mitigating both these risks in terms of longevity as well as the tax benefit that I talked about. Okay. If there are any questions, please feel free to put it in the chat, and we are very happy to address them. I am happy to, keep presenting, but it's also good to have a conversation. Okay, I'm just checking here. Okay. So some people mentioned that they are at 33 and they want to retire at 45. That's a very common thread. That means you have a long retirement period. I think the way we are going with our healthcare system and advances in medicine, you are looking for about 40 years in which you are going to be using your savings to retire. So you have to plan accordingly. Now, there is another question by Arnav. He says the Gear 6 has a return of 11% over how many years? So we took a long period, over 20 years of history, to average out and say, what is the expected return? If you look at different periods, the return can be higher or lower. Actually, over last 10 years, Indian markets have done very, very well, and the return has been over 15%, almost 16%. So it varies period to period. But to be conservative, we think the fixed income and stock market difference is 3 to 4%. Fixed income over long periods of time gives you 7 to 8%. Stock market will give you 11 to 12%. That's the range on which your returns are different. Can we elaborate on slide 7, in which we talked about asset allocation depending on the extent of savings you have? So let me go back to that. This one. Here, the question is, what does it mean that asset allocation should change based on the savings you have? Let me give you two examples. Let's say, you're a 85-year-old person and you have put away over lifetimes of savings, a few crore rupees is your savings. Your expenses at this time are, let's say, very, very minimal. So you are spending 10 lakhs a year. If that is your situation, you have more savings than you are likely to consume in your lifetime, which means you don't have to be conservative and move all your savings to fixed income. A lot of people do that. A lot of people are conservative and they say, look, I don't want to take too much risk. I don't want to have my portfolio go down a lot because I'm very conservative. I'm, at a certain age. But in this case, if you have enough or more than enough savings, you can continue to take higher risk because the period over which these savings will be used is long. So you're going to leave this money for somebody else to use, whether it's your children or somebody else. They are going to use it over long periods of time, and they can continue to benefit from the high growth rate of investing in equities if there is no risk of running out of money for your own savings purposes in the next few years. Another question is, what's a reasonable inflation expectation and I should have in these calculations? The inflation in developed, mature economies tends to come down a lot. US has had long-term inflation rates of 2%. Japan has had near zero inflation for a very long period of time. And actually, they had gone through negative inflation, deflation for some years as well. India is growing very rapidly, and that also brings periods in which the economy gets overheated and the overall inflation is higher. So expectation for a country like India would be about 5 to 6%. 5% would be the average, and 6% if you want to be a little conservative in your planning. Okay, good. We'll keep answering questions as we go along. But we were talking about NPS and its benefits. So to close out the NPS and its benefits, as I mentioned, comparison of putting money in a mutual fund versus NPS for retirement. On the left-hand side, the blue chart shows what you can do with NPS, 60% of the corpus, which would be available at no tax, or the annuity part on which every year, you have some slab rate that you will pay, versus mutual fund where you'll pay 10% long-term capital gain. And on the debt fund, you'll pay the business income. So the blended rate for you will be 18% in a mutual fund and 12% in NPS. On the other hand, the 5-year returns may be slightly better in mutual fund because of the products, but the tax rate makes a huge difference. And the other thing that I mentioned in NPS that's beneficial is the ability to bundle it with an annuity, which also helps mitigate your risk for longevity. So those are the topics that we wanted to cover for retirement planning. I'm going to be happy and to answer any further questions on how to think about retirement planning, and we can continue our discussion. Next question is about view on REIT or real estate and gold as part of retirement portfolio. I'm going to answer this question in two parts. First is, how does real estate and gold fit into a investment portfolio? Both these assets over long periods of time provide returns which are closer to fixed income return than equity returns. What happens is both of them are basically store of money. You can put your money in rupees or you can put it in gold. Rupee will over time probably depreciate against gold. So the gold in rupee terms will give you the return, which is somewhat similar to the interest rates. Same thing with real estate. Of course, there are exceptions and periods in which real estates do very well. And real estate in certain locations, which are high growth locations, can produce very good returns over those periods of time when they are going from maybe not as desirable locations to very high desirable location. People who invested, for example, in Gurgaon 10, 15 or 20 years ago, and over 20 years, that has made a huge difference in what their real estate appreciation has been. But it is comparable to fixed income return versus equities. The things with equities is your money compounds. What you put in, the business earns some money, reinvests in the business itself, and grows even faster. So the returns and risk in equity investment tends to be higher. Specifically with REIT, I would say there is risk in real estate. And the risk is that of illiquidity. You cannot sell real estate easily when you need the money. It is concentration risk, meaning you have a home in a particular location. There can be issues like, that location somehow becomes very unattractive because it's crowded, or a subway line or a metro line goes right next to it, creating a lot of noise, or other things can happen, and the location suddenly is not as attractive, in which case your investment loses attractiveness and money. But if you are invested in a REIT, which is like a mutual fund of real estate, then you don't have these two risks. So investing in REIT is better than investing in real estate for your savings portfolio. Of course, there is no substitute for having a home of your own that you can live and bring up your family. That is a separate requirement. It is not for saving purposes. But if you're thinking from saving purposes, then REIT is better than real estate. And REIT and gold will produce returns equivalent to your fixed income portfolio. There's another question by Megha Gupta, who's asking, what's our view on dividend paying stocks as part of retirement portfolio? I think the total return of a stock is a combination of dividend and its capital gains. There is really no reason to differentiate between the two. Tax rates and tax treatments can be different, and that causes some differentiation. Long-term capital gains tax up to 1 lakh is tax-free. Dividends are taxed. So I think you have to be careful about the tax consequences. But post-tax, whether you get the money in terms of dividend or you get it in terms of capital appreciation, it's the same. And really what one should be thinking about is building an overall balanced portfolio. For example, in a Gulaq portfolio, we may carry positions in 50 stocks, many of which will pay dividends, many of them will not pay dividends. And that's okay, because we are looking at the overall attractiveness of holding a stock. There's another question by Vinod. Apart from numbers, can you speak about the psychological aspect of investing for retirement? How do you think about handling retirement funds? This is an excellent question and very, very important. I think the psychological aspect of managing investment is the toughest part for most people. A lot of people watch their portfolios almost on a daily basis. And retirement investment is for periods of 20, 30, 40 years. It does not require to be watched if it has been done correctly on a daily basis. It's actually very counterproductive to do that, because inevitably what happens is people who are new to investing or not as familiar with the journey of investing typically have their money in safe assets. Maybe they have bought a house and have kept the money there for 10 years, or they've had fixed deposit or some kind of a plan, savings plan or an insurance plan in which they've been saving money. They come to a webinar like this, or they hear stock market is doing great, and they take some money and put it into the stock market. And the stock market goes up and down. It can go down as much as 30% or 40%. When that happens, people generally panic. And they say, oh my God, I made a huge mistake. I have to sell everything and do tawbah and say, never again will I take these kinds of risks. So you buy typically when the markets have a lot of buzz and there is excitement, and everybody at dinner parties is talking about how they have made a lot of money in the stock market. That's when you buy. And you sell when you have had a lot of losses. So you buy at the peak and you sell at the trough, because of the fear that comes in handling a volatile investment plan. So the best thing to do for a retirement planning person, or I guess, the best thing is to find a good plan and a way to implement it. But the simplest thing you can do is take money in the right proportion and just keep putting it in market overall and a fixed deposit based on the allocation that you have. If it is 80% in equities, buy Nifty 50 index fund with 80% of the money, month in, month out, every month. That's the second best thing you can do. Now, if you have more time and you can find people who can help you do better returns than that, which, by the way, is not easy, and maybe only 20% of the people will be able to achieve that if they are lucky, then you can think of improving over and above that. And then based on proper advice and analysis, you can decide how your allocation should change, how you should rebalance it year on year as market returns and fixed income returns vary. So we can talk about rebalancing. We can talk about finding the right products which can outperform or do a little better than index. But your base level plan, which will be better than 50% of all people who are saving, is to take the money, invest the allocation for equities in an index fund, and put the allocation for debt in fixed income and or a Bharat bond, and that's it. Next question is, I'm 48 and self-employed. My current expected EMI is 70,000. How can Gulaq asset allocation help in retirement planning? That is small cases. Please explain on reverse mortgage of home property. Okay, these are two separate questions. Let's talk about the first one. Somebody who's 48. I guess the second question you need to answer is, at what age do you expect to, stop actively working for income? So you're self-employed right now. You're probably doing some business or freelancing or whatever you are doing. At some point, you would have to plan for where you are not getting that income, and how will you support yourself? You have only mentioned EMI. That's only one part of your expense. You also have living expenses, which are not EMI based. We also have a template on our Gulaq website where we help people just estimate what are your living expenses. There are lots of books and tools which make it very complicated. Make a budget. How much are you spending on food, on commuting, on entertainment, dining out, travel, healthcare, build a big budget, get an estimate. I don't know of anybody who can do it exactly right, because we forget. We don't track everything accurately enough, don't have the time or the patience to do it in detail. So we have come up with a method which is very simple. Most people use one bank account for paying all their expenses. Just find 13 months of statements of that bank account. What comes in, what goes out is all you need to understand. What was the balance at a given period? How much money did you put in? And what is the total money that you took out? You may have to do some adjustments if you made some big purchases. But other than that, the total money you spent is right there in these 13 statements. And even if you don't have the breakout, it's okay. All you need to know is what is your expense. So EMI is not sufficient for you to do a retirement planning. You need to know your living expense when you're retired to plan for it properly. Now, depending on your age and the period. So if you're 48 and you want to retire in, let's say, 65 years of age or something like that, then you have 17 years of working and maybe 20 years of retirement. So probably you need to start reducing the risk a little bit, maybe be gear 4, maybe gear somewhere in that range is my guess based. And you can also take your risk tolerance survey that's also available on our website. And that will tell you what is appropriate gear for you. But 4 to 5 would be my guess based on the little information you have shared. Reverse mortgage is a product that allows you to use the money from your home without selling it. So in this case, what happens is you borrow against your home and use that money for your living expenses. So people normally borrow to buy the house and then they pay down every year. But in reverse mortgage, you get the money for your living expenses and that keeps getting accumulated over time, so that eventually, maybe when you're no more and the house is sold, then the money is used to pay down the mortgage that has been built up. This can be a very good alternative, because if you have a house you own, you have no mortgage on it, but you are having a difficult time meeting your expenses year on year, then really you have all of this savings, but it is not serving you in your retirement when you have no other earning. So reverse mortgage can help you with that process of converting the asset and using it into liquid expense money. There's another question which says, can I do SIP in mutual fund for long term and then shift to covered call in good dividend stocks? These are two very different strategies. I think doing a SIP in mutual fund for long term is a great strategy, and that will really help you build a solid corpus in your retirement planning. Writing covered calls in good stocks, I mean, you mentioned good dividend stocks, that's not necessary. Covered calls generally are written to augment the earning from the stock. So if your stock is at 1,000 rupees and you write a call, you own the stock and you write a call on it at say 1,200, then one of two things have to happen. Either whatever premium it is that you have gotten for writing that call, you make that earning. Let's say it was 20 rupees. So you earned that 20 rupee return, which is a 2% return, not bad at all. Or the stock goes up 20%, in which case you make 20% on that stock, but you give up. If it goes to 1,300, you give up that 100 rupee. So it's a good strategy. But I always caution people to dabble into things like this as a hobby. You have to watch these things. You have to monitor. Many times what happens is, people do these things, but then they don't pay attention to it, or they don't have the enough infrastructure and research capability to monitor it properly. In which case it can lead to risks and missed opportunities of returns. Basically, you're clipping your best performing stocks if you're writing calls too close to what they can do. So not advisable for 95+% of people to be doing these things. You can do it with an advisor who is monitoring it for you, and that is fine. But then again, you have to have the right evaluation method on what the returns are, what the risk is, how you're going to be able to get it done right. Next question by Dhruv is it a good strategy to keep funds of family expenses for next 3 years and invest the balance in equity and let the money grow? I'm 50 at a fire state and have 2.85 crores in equity. It's a great idea to have some liquidity available for meeting your expenses. And then investing the rest in equities and letting it grow. I think, as we discuss, that is appropriate. Whether you keep 3 years in fixed income or not depends on how much money. The 2.85 is what relative to your expenses. Let's say you expect to make post-tax, let's say 7-8%, 8% or something like that. At 2.85 crores, 8% is about 22 lakhs or 20 lakhs or more than that. If your expenses are less than that, significantly less than that, there is no issue. Go ahead, put all your money in equity, and then you'd be safe because it would not deplete your assets and your ability to live well off it. If your assets are significantly more, first of all, you don't then have you'd be eating your corpus, and in which case the question will come down to how many years does it have to support you? And that's where having that template, that Excel spreadsheet, helps you understand how this would play out. Because the math is not easy to do it in your head. But if your expense is more than 20 lakhs, then the planning has to be different, and the investment plan may have to be adjusted down from all risk to meet your requirements. Being debt free is obviously helpful, so you don't have to worry about the I guess that some of the money from your corpus has to go into paying off your debt. Dhruva says his expense is 12 lakhs a year. Great. You are in very good shape at 2.85 crores of corpus, investing in index. Even in index, I think post tax, you are going to do fine and be able to meet your expense and continue to grow your corpus. So for you, investing in all equities is appropriate. And frankly, you don't even need to keep a lot of money in fixed income. There is really no need for that. You can manage it in a way that you're always selling what you bought after 1 year, getting long-term capital gain benefit from it, and 1 lakh is anyway tax-free. On the remaining 11 lakhs, you'll pay some taxes and use that to continue your journey in terms of continuing to grow your corpus while consuming from your returns only. Next question by Toran is it a good idea to invest in stocks directly, or should one invest in ULIP plan? Which one is better? I'm not very familiar with ULIPs, but what I understand of ULIPs is they are unit-linked insurance plans, which means that there is an insurance component as well as an investment component. Now, ULIP plans usually have narrow range of returns that they provide, and the insurance component has to be evaluated separately. Insurance is very important for people who are income earners on whose income other people depend. So if your income is being used to support some other family members, whether they're your children, parents, your spouse, anybody, or siblings, then it is important for you to have some life insurance because, God forbid, something happened to you, people who depend on you need to have that money to continue meeting their expense needs. So you need to have an insurance plan. Whether you need to have a ULIP plan or separate investment and buy term insurance separately needs further analysis. Generally, I think in planning purposes, insurance is needed by young people. While they are earning, they don't need to be that risk averse because they're saving for 10, 20, 30, 40 years away. So it is generally going to be a better plan for you to invest properly with asset allocation into equities and buy term life than ULIP. It may be an appropriate plan for towards 40s, 50s, towards later years where you are already don't need a lot of growth. You need to start reducing your risk, and some of the tax benefits you get through ULIP may be beneficial to you. Okay. Let's see if there are some other questions here. Okay, this is hopefully useful for everyone. We are always available on our social media properties, feel free to continue the discussion and questions, and share your comments on how you like this webinar. And if you have any further questions, we'll be more than happy to engage and give you answers. There's one more question that has come in. I'm 28 and subscribed to Gulaq Gear 6, saving 50% from income and investing 30% in Gear 6. Not sure what to do with 20% remaining. Well, you are a young person and you are saving at a very high rate. So first of all, congratulations. I think you are on fantastic path. I think with the remaining 20%, I would suggest buy a very low cost ETF on Nifty. That's all you need to do. If you find another manager that has good track record and you feel comfortable, diversify. Try investing with different managers so that you are able to diversify the systemic risk of an advisor not being able to perform well. So that would be my recommendation to you at this stage. Okay, there's one more question. Okay, great. Well, as I said, feel free to send me an invite on LinkedIn. Follow me on Twitter. Gulaq has lots of material we put out in terms of learning on investments on our LinkedIn, Twitter, and Instagram, as well as on YouTube. Look forward to having the conversation with all of you, and all the best in your investment and savings journey.